Okay, well, welcome everybody. My name is John Mazzara with Remax Results. I'm glad you're here. This is your class. I want to give you everything that you came here for. Uh, Feel free to ask me questions in the chat as we are going through it. Otherwise, we will be taking a couple of breaks periodically throughout to go ahead and answer questions as they're coming up. So take notes, ask me questions at the break time. And then at the very end, there'll also be questions. Now, this is being recorded. So if you have, um, if you want this as a reference, I'll be sending this out to you to your email if I have your email. So as a first-time buyer, this is where many people start. They're concerned. They've never done it, don't know what to do. They're stressed out, intimidated, maybe a little bit anxious or uncertain and not sure where to start. So you're starting at the right place here today, and I'm going to add that clarity that you're going to need so that you feel very comfortable when that time is right. So who am I? My name is John Mazzara. I'm a broker associate with Remax Results. I've been selling homes for a very long time. I've been selling homes since I graduated from college. I'm a St. John's graduate. Graduated in 1986. I've sold in excess of 1,200 homes all throughout the metro area. I work both sides of the river, and I work with buyers, sellers, and investors. I work with a network of lenders and programs, and my goal is to help you get in the right house. I have plenty of references. You can Google me, check me out. You can see I've been around a long time. So if we're doing our job right, we make it easy for you. So it's easy peasy. Now, buying a home tends to be an emotional decision. I call it, it's like falling in love. So you just know when it's right. But we try to initially make it a financial decision, but it always defaults to an emotional one. These are all the things that we do in the background that you're not seeing us do, but we're coordinating. So there's 111 things that we've identified that are activities of an agent. And if we're doing our job well, then you're not even going to feel these things. But these are all parts of the transaction that are occurring in the background. Initially, when you meet an agent like myself, and you have a substantive contact and discussion about real estate, they'll introduce this form and it's called agency. And when you sign this form, you're not obligating yourself to anything. All you're doing is you're acknowledging. You're acknowledging that in a transaction, there's somebody that represents the seller, somebody that represents the buyer. Sometimes the same agent or company will represent both buyer and seller. And sometimes we're just acting as a facilitator. So for example, maybe you have a coworker or a friend or a family member and you want to buy their home and they want to sell you that house. You both look at each other and you say, okay, now what? That's when we do the paperwork, but we don't provide representation. You'll notice on the bottom here, lines 76 to 80, that there's predatory information. So if a seller is moving because somebody they prefer not to live next door, meaning a registered sex offender, has moved in, they don't have to tell you that because all buyers are given this website, which is where you can look them up as well as you can call their office. So that's one of the due diligence pieces if it's a concern of yours that a buyer would need to do. The seller doesn't have to disclose it, and it's not the obligation of the agent to do that research. It's on the buyer. Initially, if you want to see a house, if you're not under a buyer's contract, you'll look at this, which is called a touring service agreement. Ours goes for approximately 7 days. And basically what it says is, yep, John can open the door, walk me through the house, tell me about it, but I understand that he is not representing me. There's no obligation on either party. Ultimately, though, if you are working with an agent, after the agency form and possibly either concurrent or in lieu of the touring agreement, you'll sign a buyer contract representation agreement. And that says, yep, I'll work with that agent. And I understand that there's a cost involved. The cost is an admin fee in our case. You can see on line number 30, it's $650, as well as a percentage of the sales price. Now, that is in your buyer contract, but we reflect that back as a cost to the seller. We ask them to pay that in line number 406 of the purchase agreement. So the only cost, if they agree to pay that to you, would be the admin fee of the 650, and that's due at the time of the closing as one of your closing costs. If you never buy a home, there's never any charge. Just to give you some data, and we can do this on a macro level or a micro level. So on a macro level, This covers the Twin Cities and slightly beyond. It's a closed website, meaning only agents can go to it, and it's a compilation of data from the North Star MLS, which is our multiple listing service where properties that are listed are advertised and put up for sale. So the third line down, the median sales price, what we see here year over year, and this is the most current data, is that homes went from 379 to 390. They're up about 3%. Question would be, is that anomalous or part of a trend? If we look at the 12-month rolling average, what we see is that it is indeed part of the trend. So homes have been appreciating this past year at 3% approximately. On line number 1, 2, 3, 4, 5, 6 down, you see that the percent of original list to sale price is varying between 97.5 and 98.8. What that represents is the percentage of a reduction from the sales price that the average seller is reducing. And what we're seeing then, since it's very close to list price, is that there isn't a lot of flexibility in today's market because it's a seller's market, not a buyer's market. Now that could change at any time, meaning where there's more sellers than buyers, but at present there's enough buyers, more than enough, that are pushing the sales prices up. That's why they're appreciating, and the inventory levels are below where they were a year ago. So the last line where it says months of supply, a year ago we had 2.5 months. At present we have 2.4 months. So we're down a little bit. Supply and demand, we don't have enough supply and above average or more than average demand, prices will rise, and that's what you see here. So sometimes people ask, well, when should I buy a home? And my best answer to you is yesterday. If not, the very next time, next best time is tomorrow. But the longer you wait in an appreciating market, the more expensive it will be. Here's kind of a funny little ditty, but it's a receipt and it says the cost of waiting. If you'd bought the home a few years ago and what it would have cost at present. So the sooner you can get in the game, the sooner you can build equity. Now, very interesting. I'm in my third home, and I bought back in 1990, I think it was, or no, but 88, um, or maybe 87. But anyway, I bought a long time ago when I was about 21 years old. Today, the median age of a home buyer is 40 years old. So it's really increased. So a lot of people are deferring both from financial or just life decisions. Things are different than when I initially grew up, and people got married earlier and started families earlier. And today, that's not as much a concern, and people are choosing to rent longer rather than buy. But the longer you wait, the more it will cost you. And the advantage of buying sooner is that you build that equity that allows you to buy another home. And if you think about at the end of the road when you're retiring, the average retiree has half their assets in their retirement plan and the other half accidentally that occurred in the equity in their home. So the sooner you can get in, the sooner you can build the equity that you might need someday if it occurs in retirement. So what are the steps to home ownership? Well, one is to come to a class like this and to learn the process. And then you have a choice of being pre-approved or pre-underwritten with the lender of your choice. So we're going to talk about lenders and programs in just a moment, but that choice is always yours. Not all the lenders offer all the down payment assistance program. So think of me as your quarterback after our discussion, and you tell me what you're doing, meaning I have no money, I need to buy a home with $1,000 program. Okay, great. Then I'm going to direct you to the lenders that have that program accessible. Or if you tell me I have more than enough for 20% down, then I might say, well, then this is another lender that has their program. Or if you say, well, I want to buy in certain areas of the Twin Cities, are there any grants? And I'm going to say, yes, there actually are. I have a client that bought in St. Paul, and she has an access grant of $10,000. It's a grant, and a grant isn't a loan. A grant is forgiven. So because of the area she's buying, they want to encourage more home ownership rather than rentals, and they're willing to do that with an incentive. So some areas with some lenders offer access grants, some don't. So that's why, it's consider me your counselor to have that discussion so that I can appropriately direct where you might want to go. The type of loan you get depends on your credit and on, your where you were. Like, for example, if you were a veteran, only veterans can get VA mortgages. You may or may not want to use your veteran loan, but you can if you want. Otherwise, everybody else that's not a veteran would be using a conventional or FHA loan. And dependent on your credit score might be which way you go between those two. So, but everybody has access to those. Now, down payment assistance programs are known as DAPs. And again, different lenders offer different DAPs. So once we have that discussion of where you might want to be, I can say, well, these lenders I believe would be able to help you. Once we've got your loan in place, meaning your approval, then we can go out house hunting, but we don't house hunt before we have the money secured. The reason being is we don't want to waste everybody's time. We want to make sure that if we find the right home, that we have the ability to do it. We don't have to do it, but we can do it. And that's the purpose of the pre-approval. We've worked through all of the, if there are any bugs on getting you approved, and we move forward with a commitment letter from a lender, and then we set your search up based on that letter. Once we find a house, we negotiate on it. Hopefully, we're the only ones, but if it's a really good home and if it's in the spring market, you're going to have competition. We saw earlier that the market is such that it's a home seller's market, which means that, again, if it's a good house, probably more than one party will like it. A home that I just recently sold, that one I referenced in St. Paul, we did win in a multiple offer. And it was 3 days on the market. We actually made the offer the first day, but they held off for 2 days. So sometimes a seller will keep a home on for a few extra days to see if they can get multiple offers, and they did, but we were still the winner. After you get a house, then you generally call in a home inspector and go through some of the various home inspections, which we'll talk about. And if you're buying a condo or townhouse, you'll be able to review the condo docs. Once all that's done and everything's a go, then you order the appraisal and title work, and your loan is reviewed, underwritten, and finalized. We go to a closing and you sign papers for about an hour, and then you get to plan which holiday you'll be hosting with friends and family next year. The home search takes generally 30 to 90 days. Um, can go longer. I've got clients that have been looking for years. It can be, we find the home the first time out, it can be the 30th time out. So again, it's like falling in love. You'll just know. It happens every time. It's not a non-emotional decision. It's always emotional. So here are the steps where you can see them kind of graphically. We just talked about them. You're here on the top of the house, on the roof there, getting educated, learning about the process. Then you're going to figure out what you can afford for a budget for a house payment. You'll see a lender. They'll tell you how much that budget will correspond to a mortgage. Then we'll set up the search based on that information. And from there, we'll ultimately get a home under contract. We might be in multiple offers and lose a couple of homes along the way. That would not be unusual, but we always will end up with a house. It could take a while, but we always will. Then you'll have a home inspection, and I do a pretty good job of pointing out all the flaws, but it's always good to have another set of eyeballs, specifically a home inspector. And like I said, I'm going to talk more about that when we get to that section. Your home, once you're done with the inspection, everything is agreed upon, you're going forward. Your home is, then the appraisal is ordered and the lender finalizes the loan. We close, we have the party. So mistake number one of some of the mistakes we're going to review is not being aware of some of the buyer programs and taking advantage of them. So when you work with a down payment assistance program, it dovetails with the Fannie Freddie FHA loan process. So it's a second mortgage or a grant on top of one of the underlying mortgages. And what it's covering is the closing costs and the down payment that you maybe don't have. So remember we said you could buy a house with $1,000? Well, the difference is coming from that down payment assistance loan or grant. And sometimes they're stackable, meaning we can do one, two, or three programs at one time. In general, a first-time buyer, though, is somebody that hasn't owned a home in the last 3 years. So you may have friends or family members that used to own a home, but for whatever reason have chosen not to, and now would like to get back in the game. They may be a first-time home buyer under some of the programs. So that may allow them to, again, buy a house with $1,000. Most programs require that you complete a class either in person or online where you receive a certificate. Usually requires 8 hours of your time. If you do it online, you can go in and complete it, 2 hours here, hour there, so on and so forth. Otherwise, it's generally done on Saturdays in the morning and the afternoon, and then you get your certificate. Each down payment assistance program has a different counseling guideline and or provider. So a big one is called frameworks, but you don't necessarily want to take the frameworks class until you know that the loan program that you might want to use requires frameworks. It might require a different one altogether, and then you will have taken that class not for nothing because you'll have learned something, but you'll have taken the class when you didn't need to. The thing about the classes is that they're trying to teach you to be successful and to be a responsible homeowner so that you don't fail. The banks don't want you to fail. They don't want to get the home back. Quite the contrary. The banks want you to be successful, and that's why they teach you a class. What is a first-time buyer program? It can be specific to a city or county, or it might be statewide. So the Minnesota Housing Finance Agency, known as MHFA, is a statewide program. So you can buy a home in Duluth, you can buy one in Rochester, you can buy one in Minneapolis, doesn't matter. That's covering the whole state. Otherwise, we have programs that are city specific, like Edina, for example, or St. Louis Park, or it could be county, like Ramsey County or Dakota County or Carver County. So, depending on where you want to go, not all lenders are able to do all of the different respective programs. And that's why we have to make sure if you need one of these programs that we discuss it and direct you accordingly. All programs are going to have income guidelines, meaning you can't earn too much income. But today that guideline is generally over 100 and some $1,000. It could be $130,000 in some cases. So it's not only for lower income that allows you to buy a home utilizing a first-time buyer assistance program. So don't assume that you make too much money. You might make too much money, but like the one in Edina, when it's functional, allows for up to $150,000. That's one of the larger ones. So don't assume that you're out of the box. You might be more than qualified. Also, everything is dependent on your credit score. So if you're not eligible at the moment because of your scores, you need to work on that. I can give you some advice on that, but you need to have an appropriate minimum credit score, and each program will have their own guidelines. Some are 620, some are 650. These are for the down payment assistance programs. So depending on where you want to go, depends on what your credit score might need to be. Some loans are forgivable. That would be a grant, where they are forgiving all of it at once or over a period of years. And some are deferred, meaning you don't pay it off in full until you sell or refinance the home. So down payment assistance can either be in the form of a loan or a grant. And I mentioned earlier that these are stackable. So you could potentially use one loan, one grant, and another loan all at one time. Here's an example of what it might look like. So we have this hypothetical buyer named Anita. She wants to buy a home using the $1,000 MHFA, Minnesota Housing Finance Agency down payment assistance program. We have a hypothetical purchase of $250. She needs 3% down for a conventional loan, so that's $7,500, and she needs about $6,250 for closing costs. So the total amount she would need would be around $13,750. However, she doesn't have $13,750. She only has $1,000. Not a problem. So with that $1,000 she'll put down, she'll also borrow the $12,750 from the Minnesota Housing Finance Agency. So now she has two loans and two payments, one for the loan at $242,500 and one on the loan of $12,750. But she was into a home and she obviously is qualified or she couldn't have closed on both homes or both loans, I mean. There are various spots to look up various programs that are tied with the various addresses. So in the MLS, there's a little button, and I'm going to show you that in a second, that we can click on and see what programs might that home in the MLS might be eligible for. So it looks like this. So this is an example from the multiple listing service of a listing I had last year. You can see that little dollar sign with the check. Over there, that's the button you would click on, and then that would bring up all of the programs just like this. And then we would scroll down and see which program you might be or might not be eligible for if you needed or wanted down payment assistance. Now, this particular townhome sold to the tenant, and she was able to stack two programs. She qualified under a program called the First Generation Program, and she qualified for Washington County's First Generation Grant. So she was able to get, oh geez, $27,000 of monies. Um, so great programs are out there. Doesn't hurt to see if you qualify. Another website you can go to is the search engine under the Minnesota Home Ownership Center, and you can drop in the address of a property you might have an interest in, and that'll pull up all of the programs as well. So if you're not in the MLS, you can utilize this from this website. Then I mentioned that different lenders sometimes have their own programs. So the ones I talked about earlier are citywide, statewide, and countywide. Then different lenders have their own programs. So this beautiful lady here is my wife, and she works over at Wells Fargo. So she has one option for you that might be attractive if you're a Wells Fargo customer, or even if you're not. They have a program called the Dream Plan Home. It's their own money where they give up to a $5,000 grant as a credit in the form of for closing costs at the time of the closing. So Dream Plan Home, that's only if you go to Wells Fargo. So you may find that you don't qualify or don't want to use one of the other down payment assistance programs, but you might qualify for the Dream Plan Home. Here is that access grant that I mentioned. So Wells Fargo has a website, and you can see wellsfargo.com/come home that you can look on a map and see where they're giving out their access grants. So it shows the listings. You type in a zip code and it says all of these homes would be open for the access grant. So the buyer that bought in St. Paul that I mentioned, she's getting this 10,000 bucks. And you can see the income levels at the very bottom of the screen. They're very robust. So depending on your income, you can be over 100,000, over 105 here, and be eligible for that access grant in those areas. Again, this is a Wells Fargo program. This isn't um, a program that all lenders have available. Some other lenders have something similar, but this is their program as well as the Dream Plan Home. So it's nice to know that some of the bigger lenders have some special programs that only they are able to do. If you like your small local credit union, nothing wrong with them, but I'm going to tell you right now, they are not going to have access to most of the down payment assistance programs. They're acting more as a broker. Nothing wrong with that, but if you're planning or would like to use some of the monies that are available, that might not be the place that you stay with. And I mentioned cities. So here's a new one that just came out. So if you wanted to buy an Edina, a lot of people think, well, Edina is, out of my budget. Not necessarily so. They have a program. Look at this. It offers up to $100,000 and up to a home of $600,000. Now you have to be in a hero career. So you can see that would be hospital staff, police, fire, city workers. So a lot of people can buy an Edina. They don't realize they can buy an Edina if they wanted to buy an Edina. Another program in Edina is the Come Home to Edina program. So I've utilized this multiple times. Right now, this program is on suspension, meaning it's not funding at the moment. It will again, but they're a little short of funds. So when they get 2 million back in the kitty, then they'll start lending money again. But look at this on the bottom, 25% of the purchase up to $90,000. And that you don't have to be in a hero career. You can just be a regular person in a regular job. So a lot of the cities have special programs. So don't just assume, that you're out of the box because, you think that city's too expensive, like Woodbury or St. Louis Park or Edina or Minnetonka. They all have programs. Here's the state one, the Minnesota Housing Finance Agency. They have a couple of programs. Now, again, not all lenders can do it. So if you walk into your local small credit union, you say, hey, I heard about this MHFA $1,000 down, get a loan program. They're going to say, oh, we don't do it. Or they may say, oh, that doesn't exist. Well, I'm here to tell you it absolutely does exist. It means that they can't do it. So sometimes when you're discussing programs with lenders that don't offer certain programs, they aren't going to bring them up out of their own self-interest, of course, because they won't be able to do that loan for you. That's why you need, I think, somebody that's knowledgeable, that can act as your quarterback, that can direct you and give you a couple of names so that you can do some exploring on programs, if that's what you'd like to do. So MHFA, Minnesota Housing, and if you go to their website, you can also look up participating lenders. They have a list on their website. So great option. Types of mortgages, we talked a little bit about it. We're going to dig in a little deeper. Everybody can get a conventional loan. Everybody can get an FHA loan. Only veterans can get VA loans. Underwriting guidelines are going to be different from lender to lender. They may put what's called an overlay, meaning their own set of credit criteria over the underlying guidelines, but most everybody is fairly standardized. So figure a 620 to a 640 minimum to get you a house. You can go below that on FHA with some lenders with a larger down payment. And there are non-qualified mortgages, which we'll talk about in a minute, that are also out there as well. So that's this page right here. So we've got programs that are alternative loans. So they're not Fannie, they're not Freddie, they're not FHA, they're not VA, they're non-QM, which is a non-qualified mortgage. And they offer a different set of rules. They're very good for people that have difficulty fitting into the square peg in the square hole. Self-employed folks, for example, people that have lots of assets but maybe can't prove an income, people that have a lot of money flowing through their bank statement but don't report that. I mean, they don't report it as income. It's not like they're doing something wrong, it's just flowing through their business. I-10 loans, so people that don't have a social security number that are working here with a with a with a different number. Debt service coverage loans, those are for rental properties. Those are for where the property itself determines how much of a mortgage can be put on it based on the cash flow that it can generate. For people that are 62 years old and older, we have reverse mortgages. And then some lenders will lend their own money. So some banks can make their own rules. They follow Fannie Freddie guidelines, but they may decide to deviate slightly and then hold that as an asset on the bank's books. So we have lots of options. If you want to buy a house, let's talk. Let's see if we can't figure out a way. A conventional loan can be insured or not insured by private mortgage insurance. So one of the questions we had before the class got going was, well, tell me a little bit more. Tell me a little bit more about mortgage insurance. So what mortgage insurance in general is there for is to protect the lender making the loan against your default. If you default and they have to foreclose, then they're able to turn the loan loss back to the mortgage insurer. And because they know that they're insured, they're willing to make a lower down payment loan. So with 3% down, you don't have a lot in the game. The risk is to the lender, but with insurance, the risk is borne by the insurance company. FHA, they have MIP. So instead of PMI, which stands for private mortgage insurance, they have mortgage insurance premium, which is essentially the same thing by a different name. It's mortgage insurance to protect the lender. One benefit of FHA loans is their flexibility on credit score. So a lot of people, when they first start out their life, they don't realize the importance of maintaining a solid credit score. It's something you should protect, just like your reputation. It's got to be something that you value. It will open up doors and it will close doors, and the cost of living is greatly influenced by your credit score. So the good news is if your credit is down, within a couple of years of you doing the right things, you can have it back up significantly. So a low credit score isn't forever, but it is probably for a couple of years. Now, a lender will, under an FHA loan, make a loan with 580 or below, but they're going to require more than the minimum. And the minimum under FHA is 3.5%. Most lenders within the Twin Cities want a 650, 640, or 620 score. But again, there is flexibility with larger down payment. The sellers can pay more of the closing costs with an FHA loan now. I said can, I didn't say they would. But one of the ways that we can structure transactions is if you're short of cash and we don't have enough money or you don't want to borrow the money, is that we can ask the seller as part of our negotiations to pay a portion of your closing costs. FHA allows for the most, which is 6%. Conventional loans are 3% and VA loans are 4%. So if we're going under that strategy of let's work it into the transaction, into the purchase, that would be a reason why we would consider maybe FHA. Oh, low mortgage rates. So one of the things that about your credit score is that it determines the rate on your mortgage. The better your score, the lower potentially the rate. FHA really isn't that way. It's you have a 620 and you've got a 850. You're going to both get the same rate with FHA. So and generally sometimes it can be lower than a conventional mortgage. So you can get a better interest rate sometimes with FHA. But you have that permanency of the mortgage insurance. It stays on for the life of the loan unless you refinance out of it. FHA typically allows higher debt to income ratios, and you can choose any term you want. You can choose 15 years, 30 years, and what I might suggest is that you do the 30 and then you pay it back on an accelerated basis if you choose under a 15, 20, 25-year amortization. So the flexibility afforded with a 30 is that your payment is lower than if you started with a 15. You can't turn a 15-year mortgage into a 30-year mortgage by paying less, but you can turn a 30-year mortgage into a 15-year mortgage by paying more on the principal. So that's why doing a 30-year gives you more flexibility. Down payment assistance programs are going to dovetail in and work and cover a portion of the closing costs and the down payment. Here are the two loans side by side. FHA requires a minimum of 3.5% down. Conventional 3. Now remember, down payment assistance programs can cover that. You're going to have a minimum contribution depending on the program, but you don't have to have all of that money yourself. Credit score is a little more flexible with FHA. Again, you're going to have to offset that score with a larger down payment, and you're going to have a reason. Like, for example, maybe you would say, well, I didn't have health insurance and I had this medical situation that came up and I got behind on my bills and couldn't pay it. That makes sense to an underwriter. Sure, that's the medical situation has resolved itself. You're good to go. We shouldn't have that anymore. On the other hand, if you said, well, I was a frequenter of Mystic Lake and I got myself in trouble because I love the tables, they're probably going to say, well, you know what? Then in that case, we probably don't want to make that loan until you get that gambling habit of yours under control. So it depends why you have the lower credit score, and the underwriter will review that and make a determination. Debt to income ratios, FHA is generally a little more robust. And loan amounts, FHA is a little bit smaller. So you can see it's geared more towards a first-time buyer, whereas a conventional loan is a little bit larger. First-time buyers often lack the money, and that's why they don't buy a house. But remember, you can buy a house with little to no money. So don't let money be the impediment. If credit's an issue, let's work on getting you housing ready so that within a 2-year period, we can get you in a program. So don't let credit hold you back because it doesn't have to be forever. And one of the things about credit is that if your credit isn't where it needs to be, you need to reestablish new credit as soon as you can so that you can have something that overcomes the past credit. So sometimes people get in trouble with credit. They say, I'm never borrowing money again. Well, what you're then not doing is showing a new pattern. What they need is a new pattern. And the only way to do that is to use credit. So a lot of times people with a credit bump will get a secured credit card, for example, and then build credit that way. So even if it's 20 bucks at the gas station that you use and you pay it back, that's establishing a on-time payment history. So that's all you need are ideally 5 trade lines that are diversified, combination of credit cards, secured loans, maybe a car loan, a student loan, all of those things that are reporting positively for a period of at least 12 months, preferably 24. But you do all that and your credit score is going to go up. So credit doesn't have to hold you back. Where do you come up with the money though if you need money? If you can't qualify for a down payment assistance program, assuming your credit is sufficient, where are you going to get the money? Well, if you don't use down payment assistance, you may be able to get a gift from a parent or relative. So you could ask them. I just had a buyer get $30,000 from her grandma. So her grandma wanted to see her get into a house, and she asked, and grandma said, sure. Also, you can take a loan from most 401ks usually the lesser of 50% or $50,000 to use as a down payment. So you're borrowing your own money and then paying yourself back. Now, there is a proposal, and I say proposal because it's not law yet, that you may be able to just take a distribution from your 401k to buy a house. That's one of the things on the table. This coming year, they're going to be doing lots and lots of things to encourage more people to buy. And if more people get in the market, then the prices are going to go up, which means if you have the ability and the desire, I'm going to encourage you to buy sooner than later because you're only going to run into more people and it'll only cost you more, is my opinion on the future. Another place you can get money is from an IRA. So you can take $10,000 out of your IRA. You won't pay the 10% premature penalty, but you will have to claim it as income. And we discussed earlier about seller paying closing costs. We said FHA could allow for 6%, VA 4%, and conventional 3%. So we could increase potentially the purchase price by the amount of the closing costs that we need and offset it that way. So there's lots of creative ways that we can come up with to get you into a home. Here's what you can't do. You can't borrow money to buy a house. You can't cash advance your credit card to buy a house. You can't borrow money from other people and pay them back. It has to be a down payment assistance program or a lender. It can't be your mother, brother, aunt, uncle, whomever in the form of a loan. If they give you money on paper, it has to be a gift. They're going to sign a form saying it's a gift, and what happens after closing is between you and God. But on paper and for the loan underwriting, it's determined to be a gift. The other thing you can't have is undocumented cash. So money laundering, big deal. We're not allowed to, of course, help and facilitate that. So if you have undocumented cash, maybe you work in an industry where you get paid tips, for example, you want to get that and introduce it into the banking system at least 2 months prior to the mortgage application. Because what the mortgage application is going to require is that you have a couple of months worth of bank statements. If it's already in your bank statement, within that 2 month period, they don't care. But if it shows up during the loan process, then they care. They're like, where'd that money come from? And if you say, well, it came from my shoebox under my mattress, then they're going to say that doesn't count. We can't use it. But if that shoebox money came in before you started your loan app in excess of 2 months, then it's not a factor. So make sure if you do work in a cash and carry environment that you get that money into the system because you can't bring a briefcase of cash to the closing. Okay, buyer's eligibility is all based on underwriter reviewing. And what they're really trying to determine is, can you pay the loan back? Do you have the financial ability through income? Then they look at your willingness to pay. How have you paid people in the past? If you didn't pay them, you're probably not going to pay me. So credit is the best, or history is the best determinant of the future. So if you pay late just because, they aren't going to like that. They don't want to see late pays within the last 12 months, unless there's an explanation that's valid. So it can't be, well, I just didn't feel like it. The dog eating the credit card bill, maybe that'll work. But they ideally want to see on-time payments within the last 12 months because the banks, again, want to do one thing, lend you the money and get repaid. They have no desire to take your house and they want you to be successful. So that's why you would want to establish and maintain good credit. And then they have to look at the house itself. So is the house a good house or is the house not functioning as a house? Is it too much of a scratch and dent such that if a lender had to foreclose, it would cost them a lot of money? So if the home is a good house, if you show the desire to pay through your credit, and if you have the income that shows you can repay it, then you're going to be able to get the loan. Okay, so we're at Q&A time. If anybody has a question, feel free to let me know, unmute and ask the question. Otherwise, when questions are done, we'll move on to the next part of the presentation.
I do have a question. So you mentioned Fannie Mae and Freddie Mac.
Yes,
I've heard those names before, but I do not know what those programs are. Can you explain them?
absolutely. So they're quasi-government enterprises. They're sponsored and endorsed by the government to create the guidelines and the liquidity in the conventional loan market. So Fannie Freddie are these quasi-government enterprises that raise money through investors, through bonds and other forms of funding, treasury, and then they. Oh, my dog did decide to come down. If you hear some whining in the background, that's what it is here. Um, so that's what they are. They're the entities that provide the liquidity to the conventional loan market.
Okay, thank you.
You're welcome. Any other questions?
Yeah, I have a question.
Okay.
You had stated that with the 15-year mortgage and the 30-year mortgage, you can't turn the 15 to the 30, but you could basically pay off the 30 through the 15. Is that something that's set up, or are you basically paying off the interest earlier, like by making extra payments, or how does that essentially
Sure.
work?
Sure. So when you make a payment, it's based on principal and interest. So a 30-year loan is amortized where you're making the same principal and interest payment over that 30 years. And then what happens is it's front loaded the first part of the loan with interest more and then principal later. So the way that you can shorten the life of a loan is if you go ahead and pay more on principal. So let's say your payment is $1,000 right now. You could add an extra $200 to the principal portion of that payment, and all of a sudden that 30-year loan shrinks down to 20 years, for example. So by adding extra to the principal, you're paying it at an accelerated rate, which shortens the life of the loan.
Do you have to tell the lender that they need to contribute that extra 200 straight to the principal, or are they gonna do that automatically?
You bet. So when you write your check or have it, do it online or however you do it, you're going to be able to click the button that says where I want to allocate this extra amount, and you're going to say principal, and then they'll do.
Okay, thank you.
You're welcome. Any other questions? All right, well, let's move on. We're going to have more questions and answers later, of course. Okay, mistake number 2, not getting a pre-approval before you view homes. So I actually won't take somebody over and look at a home until I know that you can buy a house. So there's no sense in wasting your time, my time, or the seller's time. So getting pre-approved is really one of the first things I say the first thing that you do after a class like this, because that gives us a snapshot of what we could do. We don't know until a lender has reviewed your credit, your income, and to make sure that you're eligible. So those are the things that they're going to look at. You're also going to then have a discussion with that lender about the down payment. And if you don't have enough under the regular 3% down or 3.5% down or whatever it is, then there might be a down payment assistance program for you. If you make too much money, then we're going to default to one of those other areas where we can find money, which would be through potentially one of the 401k loans, a gift from a parent or relative, or the seller paying the closing costs. So there's lots of creative ways that we can come up with it, but getting that pre-approval letter starts us down that path of viewing homes. So the loan pre-qualification works as such. You're going to meet with a lender of your choice. They're going to probably send you a link for an online application. You might still do it in paper in front of them, but today everything is kind of electronic like this that we're doing today. So everything is kind of moved to the computer. So they're going to start you off with an online application. Then, as part of that application, you're going to upload your W-2s, your pay stubs, your bank statements. You may need to write a letter clarifying or documenting if there is something on your credit or something about your employment. Um, for example, maybe you work in the nursing career where you work 0.32 and your hours are flexible. It could work 0.04, 0.32, or whatever. So there's going to be different rules for different types of careers and letters and additional documentation that might be required as part of the loan process. That's why getting all of that done up front, it could take up to 3 weeks, depending. It's going to move as fast or as slow as you fulfill your tasks. So if the lender says upload your W-2s and you don't upload your W-2s, there's nothing they can do until you upload your W-2s. You can always have an online or a over the phone discussion and say, well, this is a snapshot of who I am. What do you think? And they'll give you, oh, a ballpark. Yeah, you should have no problem. But until they get the application, you don't get the letter. And we can't make an offer without a letter. So a seller won't negotiate with you until they know that you can do it. And so you either have to provide proof of funds, meaning here's the cash, it's cash in the bank or my asset account, or here's my letter from the lender. So it's so important. It's again the next step after this class at some point, I think, would be to talk to a lender or lenders, review programs, and get pre-approved. So simple tips for loan approval, call us if you have any questions. So I'm not a lender. We did have a mortgage brokerage for 25 years. So I'm very, very familiar with the programs. Again, my wife is over at Wells Fargo, but you do not have to use Patty to work with me. Absolutely not. And even if you don't work with me, you could use Patty. So Patty is a resource over at Wells Fargo, and they have their own proprietary programs as well as some of the other programs that are out there. So they're a great lender. They're obviously a big lender. But I work with mortgage brokers as well that also have programs that Wells doesn't offer, and other lenders that have their own proprietary programs. So there are lots of programs. I just can't stress that enough. I've been selling homes since 1986, and I've never seen as many programs as there are today. And that's why I hope the people that are renting because they want to rent, not because they think they can't buy a house. Because I can pretty much figure out a way for almost anybody to buy a house if they have income and credit. What you want to do while you're making your loan application is to continue to do everything that you have been doing, meaning pay all your bills on time. Keep working at least in the same industry. It could be a change from one employer to another. Make sure that you're not entering into a new probationary period. So sometimes when a company hires you, you have a 3-month probation period. You can't buy until you're a full employee. So if you do switch careers or switch industries, you may be jumping out of the box for a little bit before you can come back on that full approval. Um, be expected that you will need to provide letters or documentation as things go throughout the process. The underwriter wants to give you the loan, but they need to know, again, that you can pay the bank back or the investor back. So don't look at it as intrusive. I know it'll feel like you've given everything, blood and urine and the whole thing. I mean, it is a lot, but just know that that is part of the process. So you will be required to provide that. What we don't want you to do is to make large purchases. So don't go out and buy that new car. 1 minute after you've closed on your loan on your new house, go and buy a new car. But if you add more debt into your profile, unless you have the ability to do so, meaning the expanded ratios, you could kick yourself out of a house. And unfortunately, I've seen that happen where people say, well, I needed a new car. I'm like, well, could you have waited like another month? Because now you can't buy that house because that is in your debt ratio. So what they determine when a lender makes a loan is what you earn for income and what percentage of that income can be used for a house payment and debt. And if you're allocating too much to debt, then that means that it has to shrink the portion that can be allocated towards the house payment. So you don't want to take on new debt during the time of the loan application. Again, what you do afterwards, who cares? It's a brand new day. But before you buy and close on that new home, and I said close, because what they're going to do is they're going to do a spot pull. What they can do is a credit pull right before you close on your loan. They also can verify that you're still on the job. So sometimes what they'll do is they'll call the week of or the day before and say, hey, is John still working over at Company X? If John isn't working at Company X, then the loan's denied. Or if John's credit changed, if I was a 650 and the score minimum was 650, and all of a sudden I went out and I bought something and my score dropped to 649, I don't qualify anymore. So again, be very careful. Don't add a lot or if any additional new debt during the loan approval process. Okay, so the types of approvals, you could go on right now, Google loan pre-approval, put in your information, push a button, and you're going to get a pre-approval letter. But that letter is only as good as the information inputted. So if you put in, I earn $1 million, then they're going to approve you for a $4 million loan. What it's going to say in that letter is, this approval is only as good as the information given. Once we verify it, if it doesn't match, then this approval is withdrawn. That's what you tend to get with a qualification, pre-qualification. They're just taking a snapshot, looking at a brief bit of information. They have not underwritten you. A full pre-approval is much better. You are fully underwritten. So your income is reviewed. They do a hard pull on your credit report. They look at your down payment sources to see if they're sufficient. This can take a few weeks. But once you have that done, you're 3 weeks ahead of the game. So maybe you're renting until June and you're like, well, I don't need to start looking for the next couple months. Go ahead and get your pre-approval and underwritten approval done now so that you're ready to go. And then you've shortened that period of time. If you start right before and you find the perfect house, and you start with a pre-qualification letter, then you're running up against it, meaning you might not be able to meet a short closing if you need to have a short closing. And you may need to. For example, again, that home that I just sold, my buyer pre-approved, we were already underwritten, we're good to go. They want to close March, I think it's, no, they moved it back from March, February 17th. It was going to be March. We can do that. We said, sure, we'll do it. And we could because we had already done all the hard work up front. So you want to get all of that done up front, which then takes us to the search, which takes us to being able to make an offer. So if you have an underwritten pre-approval, you can shop confidently knowing I can buy a home. I don't have to worry about anything anymore. It has to be appraised and the title has to be cleared. But barring that, as long as you are still the same way as you made your application, you are good to go. Again, that's what I base my search criteria on. So if you said, John, I'd like to buy a home up to 400,000, but your pre-approval is only for 250, not going to be a match. We have to lower it to what your approval letter is. So we want to make sure that you're looking in the right range. And again, with an offer. So let's say there's two people that want a house. You have an underwritten pre-approval, and another person has one of those goofy ones from the online lender that they just push the magic button. Who do you think is going to have a better shot, all things being equal, purchase price and everything, at getting that home? It's going to be the one that was fully underwritten. And the nice thing about working with somebody local, and all the people I work with, except for one, are local, is that they are here. So you can meet with them. You can, of course, meet with them virtually, but if you physically want to meet with them, they are here and we'll do that for you. Getting the underwritten approval, again, I said earlier that you've eliminated a couple weeks of upfront time. And again, the best part is there's no surprises. Mistake number 3 is using the wrong lender. So not all banks are equal. Some use down payment assistance, some don't. The smaller banks and brokers and credit unions typically don't. They act more like a broker, doing traditional down payment where you pay the full down payment and you pay all the closing costs. And if you have those resources, that's great. If you don't, then that might be the wrong spot. I had a client that wanted to use her credit union and they did not offer down payment assistance programs. And I told her, you know what, you can buy a home with $1,000. We just have to switch lenders. And she's like, nope, I don't want to do it. I'm like, okay. So we waited a year. That home appreciated by 10%. So the home she could have bought for 300 now cost her 330. So the cost of waiting is real, especially in a strong appreciating market. Now we're not in a 10% market anymore, but 3%, if that's the market that we maintain, is still substantial. Small banks just aren't prepared also to do full underwriting. So when you get a mortgage, an underwriter is assigned to underwrite that loan. Now, that costs. So a broker has to hire an independent, normally an independent underwriter. They don't keep staff underwriters, depending on the size. And therefore, it costs them to do a full underwrite for you. Some of them resist that because if you never close the loan with them, then they're out that money. The bigger banks that you would be aware of that are on the street corners of every street, they have their own staff underwriting. And so they have to pay the underwriter if a loan comes in or if a loan doesn't. So they are more apt to be able to do the underwriting for you and not resist at all because they have to pay the people regardless. So you're going to have more luck getting fully underwritten. Now, the down payment assistance programs don't underwrite in advance. The only one that did was a special program that existed last year for first generation buyers where you had to be underwritten upfront. That program is not functioning, meaning they're out of money at the moment. Otherwise, the down payment assistance programs will tell you you look good, that you meet the guidelines, but they won't physically underwrite till they actually have a file in hand. So you could use it, the underwriter could underwrite you for the first, review the guidelines of the down payment assistance, and say, yep, you're solid on the first, the down payment assistance, you meet all the criteria, there won't be a problem. One of the things about Minnesota housing financing as well is that they never run out of money. Remember we talked about the City of Edina Come Home to Edina program? They are out of money at present. So if you're relying on a city or county program that is funding dependent, when they run out of money, that program goes away. So there is some urgency under some of those down payment assistance programs to use it so that you don't lose it. Meaning if that's what you're counting on and there's no money left, you can't use it until they either get replenished or we find a different replacement program. So you can see buying a house is all about coordinating and balancing these variables. Is a 30-year fixed rate always the best? Not necessarily. There's something called an adjustable rate mortgage where the rate adjusts after a period of time. It's still a 30-year loan, but the rate is lower and fixed. They typically come in 3-year, 5-year, 7-year, and 10-year arms. The advantage of that would be is if you knew that you were going to be out of that home in 3, 5, 7, or 10 years, you would match your mortgage program to the length of time that you thought you would have that mortgage. And by doing that, you're able to get a lower payment. So maybe you know you're going to be on assignment here in Minneapolis for 5 years, then take a 7-year arm just to be safe. And your rate will be lower than a 30-year mortgage. Not always, that's why we have to look at the different rates, but that's one advantage of using an arm. And the reason an arm is lower is that the lender's only committed to a fixed period of time that they have to give you that lower rate, and then it floats. It floats with the market, subject to generally that treasury bill average in addition to what they call a margin. So they add those two together and determine your rate. But what that allows the lender to do is to get that money and get a yield on their money that's commensurate with the new market. Think about all the lenders right now that did mortgages at 2, 3, and 4%, about 6, 7 years ago. All of those loans, if they had the money, that money could be lent out today at around 6%. So they're effectively losing 4% on all that money that could be redeployed better. So that's where an ARM, they might have started them at 2, but then after it adjusted, now it's back up to 6. So an ARM isn't a bad thing. You share risk with the lender. There are also rehab loans. So there are a shortage of lenders that offer them, but let's say we find a scratch and dent, something that is a nice house, the area you want, but needs to either be remodeled extensively or repaired extensively. FHA has a rehab product, and there's also a conventional product. So we have programs that will allow you to borrow the money to do the rehab. Again, the lenders that offer these are limited, but they're out there. So just know that that is another option for you if you find a scratch and dent. And then we mentioned portfolio products. So by having a wide network of resources, I can make lots of calls and help you figure out if there's a way to get something done. I had a weird situation where a couple of years ago, I had a buyer that worked for the state of Wisconsin as an employee. He came to Minnesota. They made him a contractor. He didn't have 1 year of contracting work as an independent, as his own business. But he was with the state of Wisconsin for like 8 years. But because he was self-employed and under 12 months, and he had 800 credit scores too, he didn't fit the guidelines of the loan program. So there was a small lender that said, oh my gosh, he's put 20% down, he's 800 scores, he's no risk. We'll take him in and we'll write the loan for a year. As soon as he gets, 4 more months, he'll be able to refinance us out of that loan. So there's things like that we can do that will help save a loan or create a loan that otherwise wouldn't have been created. Mistake number 4 is directly buying from a builder. So as a realtor, I can represent you with the builders. All the builder inventory of participating builders is listed on the MLS. So all the big ones that you have heard about, the D.R. Hortons, the Lennars, the M&Is, the Rylands, just to name a few, are all marketing through the MLS for us to show their homes. They want us to show you their homes. But what they want is for us to introduce you to them. They don't want you to walk over there on a Sunday or whatever on an open house and then later call up your agent and say, hey, I found this great home with D.R. Horton. Can you come on over and represent me? They want us to bring you into D.R. Horton on the initial meeting, sign you up and register you as that we were the introducers of you to that property. After that, no problem. You can stop over there, 12 times with your friends and family to show them your house. But they want to make sure that we actually did something to initiate it. So when you get your search, if we set up a search, you will see new construction in there. All I ask and all the other agents ask is that we're under a buyer rep contract and that you let us walk you in. It does not cost you any more, and it will not cost you any less to not have representation. So why wouldn't you if it doesn't cost you anything more? So that's what we're saying here is the builder's rep that's sitting in the open house is representing the builder. The buyer's rep, meaning if we're working under a buyer agreement, is to represent you and point out why one builder might be better than another, or why one house plan might be better than another, or one lot might be better than another. Those are all things that you're going to get or you should get if you're working with a knowledgeable agent. And the builder's rep just can't do that because they have a conflict. They're representing the seller, which is the builder. Now, here's the part that will come up sometimes is that the builders will sometimes want to take your pre-approval and shop it with their own in-house lender. And I would say over half of the times, their in-house lender can beat the private marketplace. So they do offer specials on financing and incentives for you to use their lender. So that might occur. So we might have you pre-approved, all set to go on an existing home, and then we find a new home, and then we have to switch with the lenders. But the reason that the builder offers an incentive and makes it very attractive to you is they don't want to build this home, get it ready to go, and then have it fall apart. If they get the assurance from their own lender that you're good to go, then they know you're good to go. And they're much more confident on building that home. Now, you still could lose your job or something like that. That's not anything anybody can control, but they know that that approval is solid. So the builders like to use their own lenders. It's always worth getting a quote and doing a comparison. At the end of the day, you get to decide where you want to get your financing. If it's more beneficial to use the builder's financing, then we will do that. I will recommend that. If on the other hand it isn't, I'll also point that out and recommend that. So it's a case by case basis, but just know that there's a new variable that will come into play, and that'll be the builder's lender and their financing specials. Mistake number 5 is skipping a home inspection when it might make sense and when it might not. So one company that I use is Heartland Inspections. They are picky as heck, and that's what you want. As a buyer using a home inspector, do you want them to bless the home, shake your hand and tell you it's great? Or do you want them to point out every little flaw, every little bump, wart, and crack, right? You want them to do the most picky job they can do. Now, an old house is an old house, and it's sufficient. It doesn't mean it's going to be rebuilt to a new house. So if you want a new house, then you need to buy a new house, especially if you're buying in the cities proper, Minneapolis or St. Paul, where the houses are older. Some of them could be in the 1800s, depending on where you're buying. It's not going to be a new house. And different things were done at various stages over time. The foundation's original, plumbing might have been updated, in the 50s, the siding might be the 70s, and the roof might be last year after a hailstorm. So you're going to have various degrees of obsolescence throughout that house. So know that going in. What I do with my buyers is I try to do a really good job of pointing out all the flaws before we even get involved with that house, so that you go in with your eyes wide open. You already knew about, the two-prong outlets or the flaking paint or the windows that weren't functioning, with the broken seals and those things. Those are all things that I try to point out so that, again, we don't want you to spend money on an inspection and walk away. We want you to spend the money on an inspection, get to know your house so that you know things that might be, I'm going to call it on the future honeydew list for you to take care of in the future. The types of inspections you can do, it starts with the base, the 50-page, $650 inspection. And then from there you can add on. You can do a radon inspection. Usually that's a couple $100. You can test for the sewer line, whether or not it's blocked or not. That could be $300. Now that test I think is really important for older homes. Many times the older homes have original sewer lines, which over the course of time have either collapsed or corroded, or in the case of a large tree in the front yard, might be infused with tree roots and might be blocked. Now, sometimes we can have it cleaned and cleared and everything functions. Sometimes it needs to be replaced and dug up, and sometimes it needs to be lined, meaning where there's a new process where you can line it with fiberglass. So we don't know any of that, and nobody does because it's not something you can look at unless you run the sewer line scope. There's a company called Ron the Sewer Rat that is very popular throughout the Twin Cities that does it, but there are others. Your home inspector may help coordinate that sewer line scope. Other things you can look at are the chimney inspection. You can test for mold. All things that you might do depending on the specific home. Now, on a newer home, you may not need to do all of these things. A basic home inspection might suffice. So I will never tell you not to do one. I'm going to tell you, here are the resources. That's one company, Heartland Inspections, Pillar to Post, another company. I could keep going on, naming names. So pick whomever you want for a home inspector. Just know this. In Minnesota at present, there are no licensing requirements. So that person, if you get a name from a family member that does home inspections, that person may not have any experience. There is no licensing requirement, and you might get wrong advice. So I've encountered that as well. But anyway, I would recommend you use a company that has lots of reviews, that has the experience to give you the inspection that you're looking to get. Another thing that's kind of interesting is some of the cities have a requirement, it's called a time of sale requirement, where the seller has to have an authorized inspector from the city, could be on the private market or could be a city employee, to come out and view the house. Richfield, St. Louis Park, Minneapolis, St. Paul, South St. Paul, West St. Paul, Orono. Those are all cities or more, but those are cities that require time of sale reports. And then those reports are supposed to be available in the home to you, the buyer, so that you've seen that report prior to making an offer. If there's anything that's found under one of the city inspection reports that's hazardous, that then is typically called out as a requirement to be fixed. Okay, if you skip a home inspection, then you're buying it caveat emptor, i.e. buyer beware. So you are giving up the opportunity to find things that might be deal breakers or what I call money bombs. For example, if you have to replace the furnace, how much value did that add to the house? Maybe none. How about the roof? You put a new roof on. How much money does a new roof add to the value of a house? Maybe none. So when you add on things that are part of a home structurally, they cost real money. You really did write a big check, but you expect that to be part of every home. So on some of the older homes, things that have reached the end of their natural life, you might have to replace those in the future. And that should be a function of your offer. We just had a client that bought a home in Lakeville, and the mechanicals are original. It's about 25 years old. And we negotiated based on the fact that while they're working today, that water heater is in excess of 20 years. And really, that's about it on a water heater. I've had them go, in less than 10, which is a bad one, but I mean, it can happen. So 20 years, you're pushing it. So that was a function of our offer and our negotiation. And The seller ultimately agreed, and we were able to purchase it at a price that we all deemed to be fair. Another thing about a home inspection, again, is that you don't have to, and the seller won't fix everything, but it gives you an idea. So if you had to put in a new furnace, what might that cost? Well, it might cost $5,500. Okay, now you know that. Could cost more than that too. Could cost 15,000 depending on what you put in, but at least you have a range of what the cost might be so that you again know what you're getting yourself into. If you don't have an inspection too, there could be things that are code violations that you're not aware of until after the fact. So if you buy without an inspection, you're on your own. A home inspection does create a contingency, so a seller can reject your offer because another offer, if you're in a multiple offer situation, might not have an inspection. In which case, then that's a solid deal. So if you're the only one offering inspections, shouldn't be a problem. If you're in multiple offers, you can ask for an inspection, or as a strategic negotiation, you could remove it, thereby eliminating that as a contingency. Now, I'm not saying you should do that. I'm just giving you that as an option. Mistake number 6 is skipping the condo document review. Okay, when you buy a townhouse or condo in Minnesota, you are given 10 days to review the rules, the regulations, and the bylaws. And you get something called a resale disclosure certificate that expresses the condition of the association, along with any lawsuits and other things that are necessary for you to know. If you don't read those, that's on you. You're given the 10 days to read them and to ask questions and to decide if what you're reading is acceptable. Now, you can shorten that 10-day down to 3-day by mutual agreement. Sometimes the seller may want to get going on their next home, but they can't buy their next home until you remove your contingency of the document review, which will expire after you've received the documents, and you have 10 days. So for us to get the documents, usually takes 5 from the association. Then you're given 10, so now we're at 15 days. So if I am a seller of the home that you're buying, I can't make a non-contingent offer for 15 days unless we shorten the timeline. So I don't know why you couldn't read it in 3 days, but you have 10 unless you decide to reduce it. Now you can get the next publication I'm going to show you from the Attorney General's website. I have that right here, the www.ag.state.mn.us. If you click on that or go there, there's a link for publications. And you can download the condo townhouse publication. It's about 4 pages. This is what it looks like. And it explains your rights. Once you're ready to go and we've got you pre-approved, then we go into the MLS and we set up a search. And we identify the minimums. For example, I would like to look at homes in these communities with a minimum of 2 bedrooms and 1 bath, garages, immaterial. I want to look at just houses. I want to look at houses and townhouses. I want to look at duplexes, triplexes, and fourplexes. So whatever you want, I can set up multiple searches. I can separate them, or sometimes I have to, like with the duplexes, doesn't merge with single family. But I can do a townhouse one, I can do a house one, I can do whatever you want. And so even if you're not going to buy for a year, what I would encourage you to do is to get the drip set up. That's what this is, the search drip. Therefore, you've been able to have whatever length of time between now and the time that you buy. You have that time to review and get familiar with areas and price ranges. And what you might determine is that, you know what, I can't find what I want in the communities that I want. So let's expand it. Let's expand our search a little bit more. So there's never too early. I've got a client, like I say, we've been looking for probably 10 years. And every day, his name is David. Every day, David goes in and searches and looks and reviews. He's probably as knowledgeable about homes at this point as I am because of his review of the areas and the prices. So he gets the daily drips of everything between about 400 and 700 in 3 different communities. So no harm in getting it. It's free. I just need to enter your information into the system and then we set it up. You approve it, off you go. So lots of resources I have. I have this book, Secrets for Successfully Purchasing Your First Home. If we meet, I will be happy to give you a hard copy. If you would like to read it online as a flip book, this is the address that you would go to and register, and then you're sent a link with the flip book. Here's what's inside it. All sorts of good stuff. And I have another PDF about building a case for home ownership. Again, the sooner that you get in the game in an appreciating market, the sooner you will build equity. Right now, there are lots and lots of apartments being built, and the rents are $2,000 to $5,000 a month. People can own for less than it costs to rent in many cases. So I had a client that bought a townhome in Inver Grove Heights, 2 bedrooms, 2 baths, 1-car garage, built in 03. We paid $207. His all-in payment is $1,800. Beautiful little townhouse, perfect for a single guy or a young, a couple of people. So anyway, getting in the game is important. It many times is cheaper than you're paying for rent. I have other books too. You may know somebody that needs to downsize or wants to invest in real estate. I have resources for all of that, sellers, buyers, investors. I also have a YouTube channel. So on my YouTube channel, I interview people that are ancillarily related. So mortgage lenders, attorneys, insurance people, all sorts of resources to give you more information that will help you on your journey in the housing process. Well, hopefully you're excited, confident, more informed, and ready to make it happen. So a couple ways we can get together. You can, of course, call me. You can text me. You can email me. Or you can go to my site here and book an appointment with Calendly. And then I'll get the notification, yep, you want to talk on this date. And unless there's a problem in my schedule, I will call you or you'll call me on that respective date. If there's a conflict, I'll reach out and say, how about we reschedule? You can also start a search for homes on my website. If you just kind of want to play around, I will set up the ultimate search for you with the MLS Direct. But my third-party site is MinneapolisStPaulHomes.com. So there's the site to book on Calendly. There's the site to search. This is what it looks like at Calendly. You pick a date and you pick a time. We would never discriminate. We want everybody that wants to buy a house to get a house. And like I said, we've got access to all sorts of programs. Now, I don't know if there's anybody on here that doesn't want to pay interest because of your religion. For example, the Harim versus Halal, the Muslim borrowers, there's special financing for that as well. So if you're prohibited by your religion from paying interest, know that there's a program for that. We've got a great lender called Guidance that does a predominant amount of Muslim financing for to be Sharia compliant. So anyway, we've got that. So like I said, we've got a program for just about everything. It's kind of a fun thing. I threw in a little bit of a survey question. So if you wanted, afterwards, you could take a quick 1 or 2 minute survey. There's 7 questions. And if you do, then I will send you a certificate to Las Vegas. So as an aside, I love Las Vegas. I go there frequently, a couple times a year. So if you need help planning your Las Vegas trip, let me know. But what would happen is if you fill out the survey, you're going to get a certificate and you have to pay the room taxes. It's about $150 for a short little trip. You do not have to take any type of timeshare presentation. Most recently in Vegas, they've been using the Rio and they've been using the Westgate, but it'll be dependent on who's offering it at that time. You have 18 months to use it, so don't buy the certificate and pay for the the fee unless you are going to actually use it. But anyway, I threw that in there as a fun thing. Also, I'm doing something special for everybody today that's watching this. So if you mention this, so that way I know that you've watched this, you will get from me a home warranty paid for 1 year of up to $675 if we are successful in buying a home and I'm representing you in that transaction. So if you're buying or selling and you want a home warranty, and I can go into more depth on what a home warranty is, it protects you if things break, subject to a small deductible. I'm going to throw that in this year and make 2026 a nice little kickoff for everybody. So, but you have to mention it. If you don't mention it, then I won't be throwing that in because that's real money that comes out of my pocket. And that's only if we're successful in me closing a home with you. That's my card. So I would love to work with you or somebody that you know. Like I said, I've been doing this a long time, 40 years, a lot of experience behind me. I can offer lots of guidance. It doesn't cost any more to work with one agent over another, but there is a big level of experience difference. And I guess with regards to that, you may have a friend or family member that does it occasionally. Uh, you're both going to learn together in that experience. And you only do this 3 to 5 times in your lifetime. You don't want to work with somebody that doesn't have the right knowledge level to give you the right guidance. So with that, I'd love to help anybody that wants me to help them. And I'm going to open up for questions here in just a second. Okay, any questions?
For the pre-approval process, I know that you want to compare the different types of mortgages, how much you could be approved for from other banks.
Yeah,
Do you generally, I know it's a lot of paperwork and everything, do you generally want to do that with 3 banks, or is that too much? Or what's the recommendation for pre-approval?
sure. Uh, the pre-approval would be based on the type of loan that you want. Like, for example, uh, let's say that you wanted the census grant $10,000 money. There's only a couple banks that offer census grants. So if you said, well, that's the program that I want, then you're only going to get pre-approved with the lender that can offer that. Minnesota Housing Finance Agency, the $1,000 program. At present, Wells Fargo does not work with the MHFA program, but they have the census grant, they have the Dream Plan Home, they have all the other county monies. So, but they don't have the MHFA at present. So if you said, John, I want the $1,000 program, okay, then I'm going to say there's 2 or 3 other lenders that I can give you that offer that program. And you might want to talk to one of them and get approved for that. So the answer is the rates change every day. So if you're a 20% down, 850 credit score conventional buyer, you're going to get a loan wherever you're going to be able to get a loan wherever you want. If you call a lender and say, well, what's the rate today? They might say, well, it's 5%. Well, it really isn't 5%, but let's just say they make up a low rate. When you actually go buy a house, you call them up, what's the rate now? And they might say, well, no, it's 6%. Or I was quoting you previously, a loan with 50% down closing in 10 days. So it was accurate, but nothing that would ever have applied to you. So it kind of depends. The other thing with some of the bigger banks is that they may have an affinity program, meaning, let's say you work for a large company or you work for a union, or you're in a union, not work for a union, you're in a union. You might qualify for a $500 gift card. So that's why I can't say there's any number that you should have for lenders for pre-approvals. It's the discussion of who you are, where you work, what you have for resources, what type of loan you might want to use, and then here's a couple of names of people and why I think you should talk to them. I think 1 to 2 approvals is all that you need. I don't think you need 3. And especially if you're going to be fully underwritten, because you're not going to want to do all the work of uploading and submitting all of your docs to 3 different lenders. You're going to do it with 1 or 2, and you may start. Let's say you were W-2, you make 100 grand a year, you've got very little debt, you've been on the job 8 years. That's a slam dunk loan. So we know everybody can do it. And then it's just a matter of who you feel comfortable with. Did that answer your question?
Yes, thank you.
Okay, you're welcome. Were there any other questions?
Yes, just a quick question about pre-approval affecting the credit scores, because we heard that if you get pre-approval and you might not purchase the home, but it could affect your credit score. Is that true?
kind of true. So a lender can do a soft pull or a hard pull. They're going to do a hard pull if you actually do the application. If you're not on the bubble, what I mean is, let's say 650 is the pass or fail. If the program has 650 and you're at 650 and you have three different lenders pull your credit, you might drop to 640. So it depends on how close you are to the cutoffs of a particular program. However, the credit bureaus know that you might talk to more than one lender when it comes time to get a loan. And so they don't automatically drop you down.
Mm.
If you had 10 pulls, yeah. And a lot of lenders will start with a soft pull, meaning they don't fully do it. It's kind of like a shadow pull. It's called a soft pull. To see that what you've told them is accurate. Like, for example, you might go to Credit Karma and open up a free account, and Credit Karma gives you a score. And you may say, I'm a 650. And then the lender is going to say, well, where'd you get that number? And you're going to say, Credit Karma. And then they're going to say, well, here's the deal with Credit Karma. Credit Karma is close but no cigar. Very seldom does Credit Karma match the same algorithmic pull that you get with a lender. So lenders use a little different algorithmic calculation. Credit Karma is going to be close. So Credit Karma 650 might really be 635 or 665 from a lender's perspective. The lender pulls three different bureaus. So they pull them from Equifax, TransUnion, and Experian, and then they throw out the high, they throw out the low, and they go with the one in the middle. So that's kind of, I guess, what I would say on credit is I wouldn't be too worried about it. I think the value of getting approved is more important than the score drop, especially if you have lots of time, just so that you validate or know exactly what you're doing, especially if you're self-employed. There are going to be more hurdles for you than if you're just straight up W-2, or if you have variable income like nursing, where you can have not necessarily full time, but full time or non full time and overtime and all that other kind of stuff. So if you have variable income, that's going to be much more important to get underwritten on. Or if you have side businesses, if you are W-2'd, but you happen to have a Schedule C and you deduct, your side hustle, that will affect you. So I've had that come up. So that's why I like to get in front of a lender. Don't worry about the hard pull. It's not going to really drop you significant. The risk of being dropped is not worth the not doing it.
And then just a follow-up question. Can you go over what soft pull and hard pull is and what situations to use a software hard pull?
Sure. So the lender will determine based on your level of wanting to make an application. If you are doing a full application, meaning here's the link, put it all in, upload your stuff, that's going to lead to a hard pull. Meaning it's going to show on your credit that on the 24th of January that you made an application at ABC Company and that somebody looked at your credit, which is an indicator that you were looking to get a loan, which means you're looking to buy a house. A soft pull, if you talk to that lender and they're like, well, I'm not really sure on my credit report. I think it's somewhere between 6 and 650. I'm not sure. Then they might say, well, let me just do a soft pull. And so they don't go through the same level and it doesn't report to the same degree on your credit. One of the things that's very annoying, and they're trying to eliminate it, is when you make a hard pull. So you make an application at a bank. That credit bureau is going to turn around and sell your name and your phone number and email to different lenders. It's called a trigger lead. So they're like, hey, John just made an application. John must be looking to buy a house. Why don't you call him up and see if you can steal that loan? That's called the trigger lead. So when people make an application for a formal mortgage, they are frequently bombarded with phone calls, emails, solicitations, trying to steal that loan. They put in some legislation to eliminate it. I'm going to say it reduced it, but it didn't eliminate it.
Wow, thank you for that.
You bet. You bet.
I have a question, kind of bringing back to kind of the middle of the meeting. You had stated that the 401 K loan or your IRA distribution, is that something that you can go to your I guess your 401k administrator about, and then they all will approve it as long as you have to just justify that it's for a home loan, or is that something that you go through the loan company that you're trying to go through to get that money with? Like, how does that kind of
How does
work?
that work? Sure.
Yeah.
Great question. Okay, so how does that work is that everybody has a different 401k custodian or administrator. Most 401ks, and I say most, allow for the purchase of a home or a hardship. And so what they require, like I just had one here last year, at the end of last year, where we had to submit, or the buyer did, the buyer had to submit a copy of his purchase agreement showing the custodian that yes, indeed, I did buy a home and I want the money for my down payment. So the loan was underwritten by the bank with the distribution coming for the down payment from the 401k. The 401k will release the money once they know that it really was to buy a house. Most of them don't require the purchase agreement. Most of them just have you fill out a form and say, yep, I want this amount of money and I agree that it'll be repaid out of my paycheck over this many years. Could be 5, 7, 9 years, whatever the term is. You might want to pick the maximum and then, of course, repay it at your leisure, meaning you can accelerate it. But you do that directly with the custodian. Um, and so the 1-800 number on your statement, on your 401k, that's the number you get started with. And you say, hey, I'm buying a house. What's the procedure? And then they'll send you the forms or send you the link or tell you how they do it. But it's done with them. And then once you have those funds and the proof of the distribution, then that's going to be underwritten from the loan perspective. So the underwriter, if you said I'm getting 20,000 from my 401k, they'll be like, okay, your loan's approved, subject to you getting the 20,000 from your 401k. So let's say it's Fidelity. So when Fidelity sends you a check, you photocopy that check, you send it in to the underwriter goes, yep, that's the 20 I was waiting for. You're good. They sign off on it, loan closes. So it's part of the process, but you have to initiate it directly with the custodian.
Perfect. Thank you for explaining that.
Sure. Any other questions? Okay.
I did have one question. Sorry to interrupt.
No, please.
Is there any like Ramsey County or even more specifically St. Paul, like FHA or conventional or those like kind of those grants or anything that you know of?
Absolutely. Absolutely. So, uh, St. Paul, that's where that access grant was used on that from that earlier slide in Wells Fargo. You can go type in the wellsfargo.com/come home. You can type in an address or a zip code, and all the homes that qualify for that 10,000 would come up. So that's the access grant, and that's applicable in Ramsey County. Now, Ramsey County also had some money. Now, they had some first generation money. So, first generation means you never owned a home and your parents never owned a home. Therefore, you are the first generation to buy a home. So, that was kind of the big thing the last 2 years. They had two different state programs, and some of the counties and some of like Washington County, where that gal got the 5,000, Ramsey County had that deal. Edina has a $20,000 deal for first gen. So that, to the extent that there's funds available, that's available to the extent that you qualify. Uh, the statewide program that includes St. Paul and Ramsey County is the MHFA, the Minnesota Housing Finance Agency. So that one has the broadest use because it covers everywhere. And there's always money. There's never out of money in that program. Then we have things like, for example, you may have heard of the neighborhood in St. Paul called Rondo. So there was a time when that neighborhood was, I'm going to say, split due to the freeway. And so some people were displaced. So a couple of years ago, there was a City of St. Paul Rondo program where if you were a descendant of one of the folks that were displaced, you were eligible for up to $90,000 in the forgivable over 20-year grant. And you may have watched TV about 4 years ago and saw a gentleman cutting a ribbon from St. Paul with the mayor in front of his St. Paul house. I was the agent for Anthony that helped him get that home and his 90,000 bucks. So there's programs like that. Um, there's places like Habitat for Humanity that have a special program for that's called Advancing Black Home Ownership. So they have a program through Habitat for Humanity that's, you know, that's specifically for that. So you could get pre-approved under that program potentially. There's different programs with different criteria. Normally it's just based on income or it's not based on ethnicity, although there are special ones that are. But most of them are open to everybody. Um, and even the interesting thing about the Guidance Financial and their Muslim home financing, that's not open just to Muslims. It's open to anybody that wanted to do it. So you could be, a Christian or whatever, or of any religion, no religion, and you want to go and get your loan with guidance, you can do that. And where that might have been really advantageous a couple of years ago was when they had a special program that they had that with their money. That was a kind of like a special grant program. So there's little nuances under each of these programs and products. Um, but they all have income caps and they all have credit caps. And those are hard stops. So if you make too much, it's a hard stop. If your credit isn't there, it's a hard stop under many of the down payment assistance programs. But kind of a long answer to your question, there are Ramsey County programs, but overlapping Ramsey County programs that are state programs. So it doesn't have to be specific to Ramsey, but yes, there are Ramsey programs.
Thank you. And then I guess one additional question I just thought of was, is it is it like an issue if we get pre-approved now, if we're expecting or hoping to be more finalizing or closing on a home within like 8 to 12 months? I know the time frame is usually about 60 to 90 days. So after that period of time, like the refreshing or the renewing takes place, like would it be just advantageous to wait for the pre-approval at that point?
Um, so you don't have to tell me on the phone here, but if your scores are on the bubble, so if you've got a 650-ish score, then you might want to wait and try to improve your score through paying down debt, doing different things so that you don't get knocked down, and then do it a little bit later. If you're 850 or really if you're above 650, if you're 700 or whatever, 700-ish, either side of that, I would do it now. And there's no harm in doing it because a credit pull isn't going to affect your score, that you're going to be ineligible for a program. So the only reason I wouldn't do a hard approval now is if your score is where you might not qualify, then it won't be advantageous to you because you'll be denied. But if your score is strong enough, go ahead and do it. And then usually the approvals are good for 90 to 120. And I think again, the advantage to the approval is the approval leads to the MLS search. And the MLS search leads to you getting very familiar with areas. So you're 8 to 12 months out. Once your approval is in place, I would say let's set up your search because you'll be an expert and you'll be very familiar with the inventory by the time you're ready to go. Let's do it. Let's go.
Thank you.
Any other questions? No other questions? Going once? Going twice? All right, so I'm going to go ahead and log off here in just a second. I'm going to stop the recording.